Thursday, June 9th, 2022, Monaco 64, home of alternative economics and contrarian views. So today we're going to start with the market report. It's going to be a little different. If you don't want to listen to the market report, I recommend you skip over to an interview I did this morning with John Adams. He's the chief economist from As Good as Gold, Australia, and we spoke about many different things. We covered Australia, of course, but the whole central banking scene, what's going on in terms of monetary policy, what's going on with the economies, inflation, precious metals, of course, as well. And I think you'll enjoy that interview. So let's see where we are now in terms of the markets. It's 10 to 8 a.m. London time. I had to get up early because John is in Sydney, Australia. So spot gold right now is at $18.50. So it's down just about $4. High's been 55 and the low's been right around here, $18.49. Silver is trading at $21.97. It's down about 6 cents. High's been 16. The low's been $21.95. The stock market remains fairly weak. We had a pretty negative day yesterday for stocks in the U.S. We were down about 1% across the board in the major indices. Tomorrow, of course, we've got U.S. CPI. And I saw a headline this morning. I didn't read the story, but to the effect that the White House or some official in the U.S. said that the CPI numbers were going to be elevated. So we'll have to see what happens tomorrow with that number. Right now, the Dow future is down 30 points. NASDAQ 100 future down 30 as well. S&P is just down about 6. FTSE is down about 36 points at 75.50. Eurostoxx 50 is down 26. To the currencies. We got sterling down a quarter at 125.06. The euro is unchanged at 107.13. The dollar's down 0.25% versus the yen at 133.89. And the dollar's unchanged versus the Swiss franc at 97.85. The dollar is down slightly versus the yuan at 668. Let's check the Russian ruble. Russian ruble has strengthened again, or the dollar has fallen. We're back below 60. We're trading around 59. We had gone up to 66 recently when the central bank in Russia cut rates. So ruble, I would say, is very strong still. To the rest of the currencies, the Aussie dollar is down a quarter. Yeah, I know the Reserve Bank of Australia has raised rates about 75 basis points in the last month. And John spoke about that. So if you want to find out more of what's going on in Australia, listen to the interview, as I said. Right now, Aussie dollar is down 0.25% at 71.70. The dollar is up slightly versus the Canadian dollar, 125.75. And the Kiwi dollar is unchanged at 64.40. To the general commodities, well, WTI crude is trading at 120 exactly. It's down about 28 cents. High's been 121.06 and the low has been 119.94. Brent crude 122.30, down a quarter. High's been 123.50, low 122.24. US nat gas is down significantly here this morning. It's down about 6% at 8.15. To finish off, let's quickly look at the 10-year yield. Yeah, the 10-year yield is back above 3%. We went above 3% yesterday. This morning, we're at 3.05. It's up about 2 basis points. Quickly have a look at the Italian bond market. Right now, it's still early days. I don't think they're trading. But yesterday, we went up to 350, and it settled around 346. So I think we need to keep an eye on that 350 level. I don't think the ECB wants to see the 10-year BTP yield go above 350 right now. So they're going to do their utmost to keep it below that level. And the best place to look at the Italian 10-year yield is if you go into investing.com and you go into the market section into world bonds, and you will find Italy there. So here's my interview with John Adams. Today I have the pleasure of speaking with John Adams. We haven't spoken for a while. He's the chief economist of As Good as Gold Australia. John, thank you for coming on the channel. How are you?
I'm doing well, Mario. Thanks for having me back.
Good. Yeah, you haven't been too active on social media up until recently. You've been doing a lot of looking into the silver market, especially. But today, we're going to look at the central banks, gold and silver, of course, and what you were talking to me about, the Fed pivot, the possibility of a Fed pivot. So where do you see things right now in terms of what's going on in Australia, what's going on around the world with central banks and monetary policy?
Sure. Well, I mean, for the last 2 years in 2020 and 2021, we've seen the most extreme, monetary policy being unleashed around the world, particularly here in Australia. So obviously, really up to 2019, your channel, my YouTube channel with Martin North, in the interest of the people, we were all warning about this global debt bubble. And obviously both fiscal and monetary policy was completely out of control in 2019. And then when the pandemic hit, policymakers were under enormous pressure. You had in February and in March of 2020, the US stock market falling 35%, a lot of panic in the markets, and the central banks wanted to basically provide or re-establish confidence so that the global debt bubble wouldn't implode. So that's when they announced QE to infinity, and that stabilized the equity markets. And then obviously that led to a huge rally in both gold and silver during 2020. And since then, particularly in terms of silver, and I'm more focused on silver compared to gold, but since about August 2020, we've been stuck at a resistance level of $30 US an ounce. And so there's that's sort of been capturing my attention in terms of the price action in silver, but also in terms of the what I would call the larger picture of silver, which is that particularly in the Australian context. I mean, here's the paradox. I mean, Jeffrey Christian's, famously out there on YouTube saying there's no manipulation, there's plenty of silver, everything's fine. I think last week he said that $22 silver is actually quite expensive, indicating or suggesting that silver may be overvalued as opposed to cheap. Well, in the Australian context, we hit a high in January 1980 in Australian dollars of $44.35 Australian dollars per ounce. In 42 years since 1980, everything that is still in demand has gone up in price compared to 1980, including gold, except for one thing, and that one thing is in terms of silver. So if you, over that 42-year period, we've had an increase in the money supply in Australia of more than 2,600%. The physical above ground stockpile has only increased by about 2x or 2.5x, and yet the price has gone down. That makes no economic sense, and that paradox, that statistical anomaly, clearly says that there is a problem in the silver market, that there is extreme manipulation, and obviously that manipulation means, in theory, that there is a huge profit opportunity to take advantage of. I mean, one of the things that people have been saying recently is that you buy gold and silver not to get rich, but to maintain your wealth. Well, I actually completely don't agree with that. What we know from microeconomics, and this is what George Soros did in the UK in 1992, is when you have a market that has either a price ceiling or a price floor, and the market price is substantially different from the equilibrium price, once you break that price floor or that price ceiling, what happens to the price? It quickly rushes to equilibrium. So when the UK government under John Major, when they fixed the price of the pound to the German mark, and the Germans were raising interest rates, the British pound was falling, and pretty much Soros realized that the pound would not be sustainable. So he basically bet everything on the pound, and then one day he bet $10 billion that the pound would fall, and basically in terms of in terms of the Bank of England, I think raised rates by about I think was it 10% in a day or 5% in a day?
5%. I remember that day really well.
Yes. So the raise. Yeah, so they raised interest rates 5% in a day, and so what happened was that they basically they had to break the peg, and then the pound basically moved by about 35%, and profit, and within 4 weeks, Soros made about $1 billion. So I wrote an article called I wrote this 2 years ago, George Soros and the Silver Moonshot. So the basic premise of the silver market is exactly like Soros. If there is a price ceiling, if we can break that ceiling, then the price will go to equilibrium. And if the equilibrium price is $100 or $500 or $1,000 US an ounce, well then those who have silver are going to make a lot of money. And so that's why I've been very interested in understanding the mechanics of the silver market, but also understanding in terms of the broader picture. Now, we have a situation, Mario, in 2022 where inflation was actually picking up, particularly in the United States, well before the Russia-Ukraine situation. That situation has added fuel to the fire in terms of particularly in terms of the oil market. So we have an inflation problem, and now in order to re-establish some form of credibility, central banks, particularly in say Canada, United States, New Zealand, Australia in particular, they are raising rates, trying to re-establish some sort of credibility. Now, in the case of Australia, we've had a 0.75% increase in the last 4 weeks across 2 meetings of the board of the Reserve Bank of Australia. And in the Australian context, we have a record household debt bubble. So these increases in interest rates are really going to smash a lot of households. And for your international audience, our RBA governor, as late as last November, told Australians that rates would not go up until 2024. And a lot of people took those statements on face value, signed 30-year mortgage contracts, which were high 6-figure, 7-figure mortgages, thinking that they would have some breathing space for the next couple of years. And now they're being caught short. And obviously, there's no one there to save them. So we've got our next board meeting in terms of the 5th of July, and we're going to, and already the commercial banks are forecasting another 0.5% increase. And so we're in this process now where we're seeing these rapid rises in interest rates. This is obviously going to have a huge straining effect on the debt bubble in terms of the various markets. So US household sector is going to feel it. The hedge funds and the corporate sector is going to feel it in the US. The housing market in both New Zealand and Australia is going to feel it as well. And so we're going through this process now. Now, the ultimate question from a macroeconomic point of view is, will the policymakers, the ruling elite of this world, are they willing to pop the bubble and have the biggest depression in world history? And why is it the biggest depression in world history? Because we have the biggest debt bubble in terms of global debt versus GDP. So my thesis has been, both in the Australian context, but also in the international context, is the ruling elite, and whether you want to call it the BIS or the IMF or the World Economic Forum or whoever it is that's running the world, they don't want to lose their political and financial power. And by having a global depression, which would result in in markets across the world being smashed and a whole bunch of some of these large financial institutions going bankrupt, that would basically destroy not only the economic and financial structure, it would destroy the power of the ruling elite, and they don't want that. And so I view this macroeconomic context not in the sense of economics, but in the sense of power and in the sense of politics. And I think because they want to maintain their power position in the current global order. That's why the pivot's going to come, because no one wants to push the economy into a depression because they believe, and again, just so your audience is aware, 10 years ago, I used to work in federal parliament. So I know a number of these politicians. I've had direct conversations with politicians in Australia about deflation, about doing the right thing, raising interest rates, popping the bubble, having austerity, trying to shrink the amount of debt in the Australian economy and trying to reestablish the Australian economy on a more sustainable basis. And they keep on saying to me, if we do even though we understand it's the right thing to do economically, it's political suicide. We can't win the next election if we bankrupt 20% of the population and we have a depression because people won't forgive us. So there is this, particularly in democratic systems, there is this view that they want to perpetuate the bubble so that they can maintain political power. And obviously, one of the interesting things in the Chinese context is, even though they have a communist dictatorship, it is a real big question. If China was to embrace deflation, would the CCP hold on, or would there be a popular uprising by Chinese people across the country that have basically, gone into severe economic hardship, whether they would rise and try to overthrow the regime? So nowhere across the world is anyone going to embrace deflation. And so that's why I think the pivot's coming. That's why I think stagflation is going to continue as we go forward and is going to intensify. And that obviously provides a very robust environment for precious metals. And I should say that even the former governor of the Bank of England, Mervyn King, has also come out and said that central banks are basically pursuing the wrong policy course, and that's why stagflation is going to intensify. So now, when it comes to precious metals, we were just talking about this off camera. There are various people who are, particularly people like Patrick Kareem or Chris Van Meulen, who are technical chartists, who are basically saying that once the pivot comes in, we're going to see a massive reallocation of capital away from bronze, away from cash, into equities, into commodities in particular, and that's when gold and silver is going to rally. And they forecast, precious metals is going to rally a lot. Now, obviously, in the silver market, we have two significant lines of resistance: $30 US an ounce and $50 US an ounce. And so the question is, if the pivot comes, which I expect it will be, and I think the US will pivot later this year, will that see a capital inflow into commodities? And will silver rally above $30 and $50 US an ounce without addressing manipulation? That's going to be the $64 million question. And personally, I've got some doubts as to whether we're really going to see. I mean, there's a lot of people calling for $100 silver. I don't think we're going to see $100 silver unless if we deal with market manipulation and all the corruption that we potentially have been seeing through leasing, rehypothecation, unallocated, pull allocated, derivative corruption that we've seen with JP Morgan and spoofing, etc. So all of these sort of issues around market integrity have to be addressed if we're going to get to $100 silver, in my view. But in the interim, I think if there is a massive capital inflow into commodities, gold and silver is going to rally, and people will profit from the current position, but it's not going to be as big as what it could be if we had a free and transparent market.
I think we're already seeing quite a big flow into commodities this year, maybe not so much gold and silver, but I have a couple of questions, like a two-part question from what you said about the pivot, and that the powers that be wouldn't want to lose power. But the flip side of that is that they might, the first question, couldn't they be doing this so that everything collapses and that democracy collapses, and then they have an excuse to bring in, they'll say, we've got the solution and we'll bring in this authoritarian system, we will bring in UBI or whatever. And the other question is, could they also be doing these quick rate rises? I know they're not very big, because I'd expect them to be raising rates at least 1% every meeting right now with where inflation is. Could they be doing this just to get rates maybe to 2%, and when the economy keels over, they can cut again? Is that what do you think about that?
Yeah. Okay. So how about I address the second question first? So, in the case of the United States, I mean, but also in terms of New Zealand, they're already forecasting, or they're already projecting that they're going to start cutting rates in 2023. So I think in the last couple of weeks there was a board member of the FOMC who said that they're going to cut rates in 2023. And in the case of New Zealand, the Reserve Bank of New Zealand have suggested that in the second half of 2023, that's when rates will start to be cut. So they definitely do want to raise rates. The view is that if they're aggressive in 2022, they're going to drive inflation back down to 2% next year, and that will give them the space to reverse and pivot and start cutting again. Now, one of the interesting things that just happened in the last 24 hours in Australia is that the former governor of the Reserve Bank of Australia, Ian Macfarlane, has just he gave a speech yesterday, and he basically said that he believes that the official interest rate, so we started at 0.1% at the beginning of May. He thinks it'll go to 4%, which will be murder for a lot of households. But even at 4%, he doesn't think that the inflation rate will get down to the inflation target of 2 to 3%. He thinks we'll be stuck at 4 to 5%, and that will have to be the rate of inflation that we have to accept. So even former officials, are very skeptical as to whether we're going to get inflation back down to where we were. But obviously, I do think, and even the officials themselves are flagging that they're going to raise rates aggressively. Hopefully, that brings down inflation to a acceptable level, and then they cut them in terms of pivot. Now, in terms of, is there a new solution in terms of where they could take us? Now, the only thing I'll say, and obviously because you're older than me, Murray, you may have a more broader historical perspective than in terms of me. If you look at, say, Germany in the 1920s, did the Weimar Republic collapse with hyperinflation? Technically, it didn't. And obviously, they went from the Reichsmark to the Rentenmark, and the Rentenmark was backed by gold, and so they were able to transition to a new currency system without losing the political structure of democracy. But when they went into deflation, well, that obviously, if you look at the German national elections, the Nazi Party was at 2.8% national vote in 1928, and they went to 33% in 1932. So they went basically they were able to capture a third of the electorate with deflation. And I think maybe the thinking among the elites is that deflation poses a bigger threat to political power compared to inflation or hyperinflation. Now, obviously, they obviously understand that there are problems with hyperinflation in terms of social breakdown and economic breakdown, etc. So how can we, obviously, if fiat currencies are losing value, if they're rapidly getting depreciated, if there's runaway inflation, how do you bring on a monetary reset without deflation? So you need to move to a new currency system or a new monetary system. And so this is where different ideas are being floated about, central bank digital currencies, whether there's some sort of crypto standard or a return to the gold standard, etc. So, now I have the view, and I did this show on my show with Martin North recently, where we said Satoshi Nakamoto is the deep state. So I have the view that cryptocurrencies, in effect, is a psychological warfare operation to convince people to accept digital money so we can transition to the new system. And the new system, is likely to be central bank digital currencies. Now, one thing I will say is, and I wrote a lengthy article about this, not every digital currency, central bank digital currency, is the same. It all depends on what the design features are, and there's a lot of things that central banks can do in terms of how they set up their in terms of their digital currency. So a digital currency may operate in a completely different fashion in Britain compared to Australia. So it depends. So it could be used for a tool for good. It could be used as a totalitarian, social credit score nightmare. But obviously that depends on what policymakers do and whether their local populations whether they will accept in terms of that new regime. And obviously, we've probably talked about it in a previous interview. In 2019, the former government now tried to criminalize physical cash in Australia by making it illegal to do cash transactions above $10,000. And so me and my co-host, we basically launched a national campaign, and it took us 16 months, but we were able to defeat that law. And so it's still now perfectly legal to do cash transactions in Australia above $10,000, and we were the second country in the developed world to stop this law. So Germany stopped it in 2016. There was a national newspaper in Germany that opposed the introduction of making cash transactions illegal above a certain level, and then we did in Australia. So what we showed in that campaign that through the use of YouTube, through the use of grassroots democracy, the people can rise up and stop interferences with monetary freedom, with limitations about how to use cash and how to operate freely in terms of the physical financial system. So if there was a move in Australia or the UK, wherever, to bring in the the central bank digital currency, if there was a move to bring in a social credit score, or to bring in negative interest rates, or to fully ban physical cash, I think in Australia at least we've shown the possibility of fighting back and stopping that sort of agenda. Now, is that agenda going to happen? We'll wait and have to see. But if they're not going to go down deflation because it could threaten democracy, and they're going to go down the hyperinflation route, well, yeah, rather than allow hyperinflation to happen like in Germany in 23, they need to transition to a new monetary system. And I think that's what the IMF and the BIS are working in the background with central banks, but these plans haven't come into the full focus of the population at large.
Yeah, I think if we get deflation, a bad collapse or depression, or even hyperinflation, it's going to be good for the precious metals, gold and silver. And because if you look in the 1930s, yes, gold was confiscated in the States, but they had to revalue it from $20.67 an ounce to 35. And if you look at the miners, like home stake mining was up 500% in the 30s. So even in a deflation where everything collapses and people go bankrupt, companies go bankrupt, countries go bankrupt, if you have physical gold and silver, you've got no counterparty risk. So I expect gold and silver to do well in such a situation. But I think that our policymakers, you were talking about the Reserve Bank of Australia governor, the current one, I think, is his name Lowe? Or
yes, correct. Yeah.
He said recently, they wouldn't raise rates till 2024, and here he is now raising it. So I think they're clueless. They think that people will be okay to see CPI go down from 8 to 5, and then they'll stop. But that's not going to stop the inflation, because as you know, this inflation has been baked in the cake from years of QE, money printing, zero rates. What we're getting now is the rising prices. So
yes.
Yeah. Any thoughts on that, John?
Sure. Yes. So because in terms of the Australian economy, our household debt, our debt profile is very similar in terms of what happened in terms of the Irish economy before the GFC. So in Ireland, but also in Australia, most of the debt is held by middle to upper income households, whereas in the United States, a lot of poor people through subprime mortgages borrowed to buy a house where they shouldn't have qualified for the loan. So while there's a lot of market commentators here in Australia who like to focus on the US market and subprime, the Ireland example is the key one. And so why did the GFC happen, and why did the Irish economy collapse in a household deflationary episode? It's because from 2003 through to 2008, interest rates were going up. So interest rates went up in the case of the US, in terms of Australia, in terms of the ECB, which Ireland was a member of the European Union. I think interest rates, over that period, that they effectively doubled. And so they raised interest rates too large. Then obviously once you started to see subprime and concerns in the financial markets and obviously contagion, Lehman Brothers, etc., all of those issues came to a head, and then basically the collapse of the Irish economy happened. So basically, if the world central banks continue to raise interest rates too much, something is going to break in the financial markets. That's going to lead to contagion in the financial institutions. And then obviously for those economies that have too much debt and too much leverage, that's when you're going to see some real big problems. And they want to avoid that. But having said that, in the last couple of years, we have seen some classic examples of countries getting into too much debt and things going basically pear-shaped. So one good example is Lebanon. So in 2019, the Lebanese government, in terms of government debt to GDP, they were, I think, number 2 or number 3 in the world. And so what happened in 2020? Well, the Europeans weren't willing to finance their current account deficit anymore. So they pulled their capital. So you had you had a crash in the Lebanese pound, you had a sovereign debt crisis, and you had hyperinflation. So you look at what happened in Sri Lanka now. So again, the Sri Lankan government got into too much debt, sovereign debt crisis, the Sri Lankan currency collapse, and now you have huge issues with rioting and people being able to get food. So Venezuela, in terms of Venezuela as well. So particularly there are particular countries which have already suffered in terms of being in a bad economic position and the financial markets turning on them. So so yes, they are small developing countries, whether Lebanon, Sri Lanka, or Venezuela, or something like that. But obviously, for the developed first world countries, they don't want that to happen to them. And so again, I mean, the point is, even 2 days ago, Mario, the Reserve Bank of Australia said, we have a robust economy, we have high economic growth, we have record low unemployment, we have strong business investment. But what we don't know is how will household spending respond to increases in terms of monetary policy and in terms of interest rates. And so that's obviously the most important question, because households basically hold the bulk of the debt. And so if you don't anticipate how they're going to respond or what their level of interest rate sensitivity is, it's very hard to set policy and actually understand what the impact is going to be. So we're flying blind in Australia in terms of raising rates. And there'll be, obviously, I think there'll be 2 or 3 months of raising rates. They may want to slow down a bit and just see what the impact will be. But again, they're going to attempt to bring inflation under control. Obviously one of the interesting things that some of the technical analysts are putting out there is that we're having oil at $120 US a barrel, and there are forecasts that oil is going to rise to 140 to at least potentially $175 a barrel. So the inflation is not getting under control, and even if you go back to the 1970s, if you're going to get inflation under control, the cash rate or the official rate has to be above the rate of inflation. So I mean, in the Australian context now, our first quarter inflation rate year on year came out at 5.1%. Now, once we get now in the next couple of days, we'll see what the US inflation number is, but probably in a couple of months' time, we'll see the next inflation number for Australia, which will again go up. So if you want to have any hope of tackling inflation properly, whether it's in America or whether in Australia, interest rates have to go to at least 10%. And if that was to happen, the financial markets would collapse, the banks would go and basically would have 1929 happen all over again, and basically no one wants that to happen. So that's why they're not going to get the official interest rate to the level of inflation, and they'll raise it as much as they can. And even last month when Jerome Powell gave his press conference after they raised interest rates by 0.5%, he said we'll continue to raise rates subject to economic and financial conditions. So he's already given himself a caveat and said, we will raise rates up until the point that we think the financial markets are going to break, and then we're going to stop. So that's the current situation, and the real question is, well, how much more we will see before the financial markets, signal to the Fed that enough is enough.
Yes, and we're starting to see in Europe as well, in terms of sovereign debt, that Italian yields are starting to rise very sharply, and the ECB now is concerned about that. And even though they're saying on one side that they're going to start raising rates by 25 basis points, they're talking about increasing the QE to help Italy. So it's really up in the air things. And you noted that the Australian governor of the central bank said recently that the economy is strong. But how can the economy be healthy and strong if you've got inflation so high? I think my view is that all the money printing and the liquidity has created like the situation, and they're trying to blame a strong economy on inflation, which is a totally Keynesian fallacy. But any final words, John, to the viewers here as we wrap up?
Well, I mean, the thing is, yes. So in terms of precious metals, and in terms of where we're going, in terms of the next few months, it's going to be very important to watch. And again, I don't think they actually have to pivot. All that I think the central bankers have to signal to the market is that we're slowing down, or we're pausing our rate tightening cycle, and then you're going to start to see a massive shift in capital. And so, particularly if you look at the silver market, if you look at the COMEX in warehouse inventories, if you look at the technical position in terms of the commitment of trade report, silver is looking very bullish at the moment, and it just needs a signal for it to rally. But then when it does rally, the question is, how high will it go? Can it get above $30? Can it get above $50? Or do we need to address manipulation? And we really haven't had the chance to address some of those points, Mario, in this conversation. But hopefully I can come back and we can really get into silver market manipulation, and what's it going to take to fix that problem, so that we can see triple digit silver.
Yeah, especially with like crude oil being like 120. I think in 1980 it was at 30 or $40. You'd think silver would be at least $50 right now. So yeah, John, I'd love to have you back to talk about the silver market. And thank you for coming on, and I wish you a great day.
Thank you very much.